Hello, everyone, and welcome to another episode of Selling Greenville, your favorite real estate podcast here in Greenville, South Carolina. I'm your host, as always, Stan McCune, your realtor right here in South Carolina. Yes, you're a realtor. If you're listening to this, hopefully I have been or will be at some point your realtor. And you can find all of my contact information in the show notes just in case you don't have that, right? You can't use me as your realtor if you don't have my contact info. Which, by the way, if you ever have a hard time reaching me, make sure that you text me. Make sure that you don't just assume that the way you're trying to reach me. A lot of times people will email me. That's the main one where we run into problems because sometimes the spam folder will filter out those emails. So please make sure, really the most foolproof way is just to text me. I will receive those texts, and if I don't respond to something, I just didn't get it, right? I respond to everything. And that's not me bragging. That is a part of my job. I'm required to respond to everything. Now, right now, I am currently in exercise clothes because that is the way I am dressed at the moment, because I am trying to get you guys content, and it's been a crazy week, all right? It's been truly, truly a crazy week. Tons of stuff going on right now, and you know, sometimes in August we get this kind of late, last gasp of the busy season, and that is exactly what I have been experiencing, at least, and I've heard that some others are experiencing it as well. So this podcast obviously goes on the back burner, right? My clients get priority. But here I am. I just did a little bit of exercising. I haven't even had time to shower yet. But you guys need content, and I am going to get you some content. So we're going to be talking about mortgage rates. And honestly, I'm so discombobulated. I don't remember if I told you guys, but please hit the like button. If you're watching on YouTube, thumbs up, hit it. Doesn't take very long. Hit that button. Make sure you hit the little bell on YouTube to subscribe to the channel. On whatever podcast platform you're using, please make sure you subscribe. Don't miss future episodes. All of those good things. Whew! I'm a little rusty on the podcast thing, right? This is the first time that I've been behind in a while. I've actually recorded out my podcasts for quite some time. And of course, the one time I don't do it, I get super duper busy, and now I'm running from behind. But that's okay. I'm going to wing it a little bit today because we have some stuff to talk about when it comes to mortgage rates. So mortgage rates have been doing some interesting things lately. I'm actually going to screen share for you guys and show you real quick. If you'll bear with me 1 second. So currently on Mortgage News Daily, which just disappeared on me, so let me pull that up here. Currently on Mortgage News Daily, the 30-year fixed rate is 6.58%. Now, I am going to clarify for those that care that doesn't mean that is what you will qualify for, right? These are aggregates. These are averages. This is not inherently what just anyone will qualify for. You may qualify for that. It may be higher. It may be lower. You never know. Okay? Depends on a lot of different things. Now, with regard to where that puts us in general, if you're looking at the chart, if you're on YouTube, you'll notice that we are near the bottom. We're pretty much at the bottom. Not completely at the bottom, but we're pretty much at the bottom for where we have been for the year, right? And you'll notice there was this big drop-off that happened end of July into early August. What happened there? Well, there's a few things that have been happening that have been impacting these rates and have caused this decline. You can see they peaked out in May, and they've kind of come down a little bit since then. And right now, like I said, they're lower than they've been at any time since late last year. What is going on? There's been a few things in the works, okay? One of those things is that it got leaked, maybe intentionally, maybe not, that the Trump administration is now considering replacing, they're now front runner for replacing Fed Chair Jerome Powell, which you may or may not have heard about this, right? The Fed Chair does not normally become a mainstream person that people are talking about. But Trump has, he does things that are just different, right? And people are talking. You're hearing things about Jerome Powell. There was a whole photo op with Trump and him with hard hats on. It was funny. At least to me it was. And so it's very, very clear that Trump, who appointed Fed Chair Powell, is not happy with him. And honestly, I can't blame the president. I'm not happy with Fed Chair Powell either. He's got a major problem, okay? And that is that he focuses on lagging data. He stopped paying attention to his models. And I told you guys this years ago. I told you guys that the Fed was no longer focusing on forecasts and modeling out what was going to happen. They were only relying on lagging data. Well, that's a problem because that's how we end up in recessions, or that's how we end up in bad financial crises, is when you're only looking backwards and you're not looking forward, right? The Fed's job, all of us can look backwards, right? I can look at the old jobs data. I can look at the old economic data. I can look at the old inflation data. Anyone can do that. The whole reason why we have a Federal Reserve, at least one of the main reasons why, I shouldn't say the whole reason, but one of the main reasons why we have them is to have a group of so-called experts who can actually forecast what's going on in our economy and what are monetary policies that can help to produce growth and that can help to avoid recessions and negative GDP prints and all of that. Well, Jerome Powell is not up to that task, and this is not a recent phenomenon. This goes back to COVID, right? He was slow to the punch on so many things with COVID. Now, he did reduce rates very aggressively during COVID. I wouldn't say he was slow to the punch on that, but he was way, way, way slow to the punch on increasing rates. By the time we started to increase rates, inflation was already way out of control, and it was already too late. And so then he had to hike rates way too high, put a whole system shock into the economy. And here's what we have. Now the economy has just kind of been struggling for several years now, in large part directly as a result of the Fed. The Fed caused inflation by what they did, by reducing rates way too low for way too long, right? That was a big part. There were other things. There were supply chain shocks as a result of COVID. There was all that fiscal stimulus that was being pumped into the system that Trump and Biden both did. But a lot of, in my opinion, a lot of the inflation, the reason why we're still having inflation, we're well past all of that stimulus. We're well past all of the COVID supply chain shocks. So why do we still have this inflation? It's because the markets still haven't recovered from what the Federal Reserve did, in my opinion. Okay. And I'm not an economics expert by any means, but I track this very closely, and I follow and I read a lot of people that are experts that I trust and that have tended to be correct for quite some time, or at least have a good track record. So it came out that the president wants to currently, the front runner to replace Fed Chair Powell is Fed Governor Waller. That is great news. Now, if you know me, you know I am not personally a huge fan of the president. It is what it is. Not going to have that discussion on this show, but there's a lot that I don't care about. I also didn't care for Biden either. So this isn't a partisan thing. This isn't, Stan the big liberal. No, actually, I'm actually a libertarian, generally speaking, loosely speaking. And I just struggle with the policies of both these presidents. But I love the idea of Governor Waller replacing Powell as the Fed chair. I think that would be fantastic on multiple levels. And not just because Governor Waller has said that he thinks we need to reduce rates, which he has said we need to do that, but he actually has data. He's actually focused on data, focused on forecasting, not just lagging data. And he can actually coalesce the entire Federal Reserve to row in a direction, right? That's one thing about Jerome Powell is he has gotten the Fed to row in this direction of these higher for longer rates that have been very damaging to a lot of the economy. he's convinced them to go along with him. Well, we need someone that can convince them, that can convince the other Fed voters, governors and presidents of the Fed, that it's time for rates to come down, that we need to do this. And I believe that we need to do this to save the economy, me personally. This has nothing to do with real estate. We've already been in a recession in real estate for 3 years. I mean, what would be another 3 years of that, right? Nobody's coming to save us. But the economy is a whole nother story. And I think that Governor Waller is the guy, okay? I think he is the guy who could come in, who could show the other voters of the Fed that, hey, the time has come. We need to start tapering things off slowly but steadily and find a neutral rate that is lower than where it currently is, so that our economy doesn't tank. I think that is immensely, immensely important. And so the markets really, really like that, okay? Bond markets really like that. People started buying Treasury bonds, and that causes Treasury yields to come down, which then in turn causes mortgage rates to come down, okay? Then we had some weak job numbers. Now, and some weak economic data. That then is what caused, when you saw that straight line down that I showed you on the mortgage rates, that was precipitated by the 10-year yield and bond yields in general coming down, because here is, generally speaking, the conclusion that people have about the current Federal Reserve, and this is not an unwarranted conclusion. This is essentially what the Federal Reserve has said. They are focused on the job data, the labor data, right? Jobless claims, unemployment, what sort of raises people are getting, in terms of the actual data on wages. Gosh, that was a hard one for me. Wage data, all of these things, those are the data points the Fed is focused on, right? Because if those get bad, then inflation is going to come down, right? So they're less focused on the inflation data right now than they are focused on the jobs data. So what happens is the mortgage rate is indirectly pegged to the 10-year yield, right? To the bond market. People start buying bonds. That means mortgage rates come down. Specifically, the 10-year, we need to see the 10-year yield get bought up. We need to see those yields start to come down. That causes then mortgage rates to come down. What bond traders do is they try to time the market. So they try to get ahead of the Federal Reserve. So if they think the Federal Reserve is going to imminently start to reduce rates, then bond traders will start to buy Treasury bonds. And then that will cause mortgage rates to come down ahead of what the Federal Reserve is doing. Okay? That's what's happening here. And so when that kind of poor jobs data came out, poor economic data came out, that's exactly what happened. Now, I'm recording this on August the 12th. We had some not so great inflation data that came out. Well, we didn't see a huge fluctuation in the bond market. The bond market kind of held the line. And again, that is because they don't really care too much about the inflation data anymore. Like we've seen, for the most part, a steady decline, and it's bumpy, it's noisy. Some months up, some months down, some quarters up, some quarters down. But the trend has been downward. And ultimately, like I already said, if the economic data continues to deteriorate, the inflation data is going to go down. And so this is what everyone currently is focused on. And so, and rightfully so. I think it's the right thing to focus on. So we have mortgage rates down at the lowest point they've been in quite some time. Hasn't really helped. Hasn't helped the market. That's not why I've been busy, by the way. Has nothing. I haven't had any clients come off the sidelines because, rates have come down. I don't think that most people are even aware that mortgage rates have come down a little bit. It's marginal, right? We're talking about from the low 7s to the mid-6s. That's not enough to bring people off the sidelines. It probably needs to go into the very, very low 6s or high 5s to really start to see like actual movement in terms of people getting off the sidelines and realizing, oh, I can maybe afford, that next house, or maybe I can afford my first house finally. That's my personal opinion. We've talked about that before. But where we are at in this moment is we're seeing some stability of mortgage rates kind of in the mid-6s. And unless the economic data starts to come in better, I think that we're going to continue to see that. Now, if economic data continues to deteriorate, we'll see the 10-year yield come down. We'll see mortgage rates come down. Kind of pick your poisons, right? We don't want the economy to go into a recession, but at the same time, we need it to kind of toe the line in order for some of these rates to actually come down. Now, unfortunately, the president just fired and hired his own person in charge of the Bureau of the BLS, Bureau of Labor Statistics. Nobody likes, whereas everyone liked Governor Waller as hopefully the guy that Trump is going to pick to lead the Fed next year. Nobody liked who he picked for the BLS. And so now we're going to have, moving forward, I don't know what that is going to mean, because we're going to start getting this economic data that analysts are going to say, is this even correct? Or is this all partisan? Is it being made to look better than it really is because Trump picked someone who he thinks is just going to make the data look good? That's not what I'm saying. I'm saying, I'm not saying that that's what's going to happen, that the guy that he picked is going to do that. I'm just saying that that's what the chatter is out there. And the chatter is very important because, again, like I said, markets are trying to figure out what is happening in real time. And so if they don't trust the data, then markets are just going to start guessing. And we don't know what direction they're going to guess. Are they going to think things are worse than they are? Or things are better than they are? I don't know. If they think things are worse than they are, then perhaps we could actually see rates come down even further. Maybe that's the big brain idea here that the Trump administration has, that okay, I'll put someone in there that's going to say things are better, but the markets are going to think it's worse. And so the public is going to hear things are better, but the markets are going to think it's worse, and then the markets are going to drive rates down, which is what I want in the long run. I don't know. That would be an insane strategy, and if it works, that would be even more insane. But we live in insane times. I have no idea. All that I know is that we don't know anything right now. But I am excited about the possibility for Governor Waller being the Fed chair next year. The possibility. I really hope that Trump sticks to his guns. I think he's getting that. I think he's got Scott Bessent in his ear, really encouraging Governor Waller. There's been floated some other names that would be really, really bad if Trump picked them instead. I think at this point, we pretty much know, for the most part, I think it's going to be Governor Waller, and that's great. Now, I don't think we know exactly how many rate cuts the Fed is going to do this year, but now there's starting to be chatter that there might be as many as 3 rate cuts. Now, I don't think that Jerome Powell is going to want that. And he actually gave out a really snarky press conference recently, and then looked really bad afterwards when that bad economic data came out, because this is his legacy. He's coming into the final year or the final few months. He is in the final year. In the final few months of him being the Fed chair, and the whole thing, his whole legacy hinges on what happens with this inflation, what happens with the economy. And right now, the jury is out. We don't know yet what his legacy is going to end up being. But if he doesn't want to cut rates, he really runs the risk of there being a mutiny, because he has to convince the rest of the voting governors and presidents in the Fed to vote one way or another on cutting or not cutting and staying neutral. And there's been a lot of people from the Fed coming out saying, yeah, we need to cut. and a few of them that are just like, we might be falling behind here, and that's really, really bad for Jerome Powell. And depending on whether that starts to gain steam, we could see mortgage rates start to come down even further. Again, so much depends on this economic data, whether it continues to go in the negative direction or not. In the ideal world, we would see it stay negative, but not get too crazy negative, right? We don't want to, we don't want to go into a recession by any means. But we want the data to reflect what's actually happening, right? That's at the end of the day what this is all about. And you hear everywhere that the economy is not in good shape. Why are people saying that? Are they just making that up? I don't think they're making that up. I just think that the reality that people are experiencing hasn't hit the data yet. And I think that's my critique of Jerome Powell, is that he's relying on the data that is obsolete, quite frankly. And he needs to be, talking more to people about what is actually going on out there. And believe it or not, the Federal Reserve does do that. They do talk to business owners. They do talk to heads of corporations to try to piece together this whole economic puzzle, knowing that data can be flawed. It's never going to be perfect. And so here we are. We could see mortgage rates come down a bit for the rest of the year, but now we have the question of whether any of the data that the Federal Reserve is relying on and that the markets are relying on is going to even be trusted. And now, who knows what will happen. Now, there's another thing that we need to talk about, and that is the spread, okay? If you don't know, or the spreads, plural. If you don't know what the spreads are the gap between the 10-year yield and the 30-year fixed-rate mortgage, okay? So, we'll talk about that for a second. The 10-year yield, as I'm recording this, is 4.289%. The 30-year fixed-rate mortgage is 6.58. So, you take 6.58 and you subtract from it 4.28. What do you get? You get a spread of 2.3, or what most people would say 230 basis points. That's the current spread. That is historically quite high. Historically, we would see 150 to 200 basis points. So where the spread is, or where the 10-year yield is currently at 4.289, really, we should see rates in the low sixes. Maybe even the high fives, depending on what, if you're looking back historically, what you're looking at. What impacts the spreads is market and perceived market volatility. And so the spreads really got really wide during, when all of that inflation went crazy. Markets were volatile. People didn't know what was happening. And there's a reason why this happens, okay? The reason why this happens is that market volatility causes lenders to need to be able to collect more money up front when they write a mortgage. And so they have to price their mortgages more expensive than they normally would in comparison to some of these other products like Treasury bonds that they could invest in, okay? That's a really, really big picture explanation of that. Well, spreads have narrowed, right? They went up to like 300 basis points at one point. They're down to 230. That's good. They can come down even further. And they have in recent weeks, they have come down. And that's part of, even though I just said recently that the 30-year fixed rate mortgage is at a pretty low point for the year, the 10-year yield is not at the low point for the year. In fact, it has come down quite a bit lower than where it is now several times this year. And so what has happened is the spreads have gotten better. People have gotten a little bit more comfortable. The markets have gotten a little bit more comfortable with the state of the economy. And it's not about that the economy is in great shape. It's more that there's a predictability element. The unpredictability of tariffs on, tariffs off, And again, I apologize for being really political. I'm really not trying to be political. This is literally just the truth. This is just the reality. You can say, oh, this is being really partisan. I'm not being partisan. Like, just talk to some people, read some books about the economy. They'll all, anyone that is not partisan will agree with what I'm saying. And that talks about, that is an economic expert. They will confirm this. But all the tariffs on, tariffs off, is it going to be 15% tariffs? Is it going to be 75% tariffs? 1,000%? Who knows? That's not good for from the standpoint of volatility. People don't know what's going to happen. Well, they've finally started to get more comfortable. They finally started to get markets, that is, traders, investors. They've finally started to get more comfortable with, okay, we kind of have a sense for what the president is doing. We kind of have a sense for what the economy is doing, for what Congress is doing, for all of these different things. And so that's caused the spread to loosen up and to narrow a little bit. We need it to narrow even more, right? That's the simplest way for mortgage rates to go down, is if that spread goes down. Will it happen? I personally at the moment don't think so. I think that there's still so much concern, and we probably won't see a major element of that spread coming down until maybe elections next year. It's really hard to say. It's really unpredictable. But we have a few different ways that mortgage rates could come down. It's more likely that they'll come down at this point than that they'll go up. But there is one more little twist that could cause them to go up that we don't want to happen, and that is the privatization of Fannie Mae and Freddie Mac. This is something that has been talked about for quite some time. You'll remember back in the day, pre-financial crisis, Fannie Mae and Freddie Mac were private. After 2008, they basically were taken over by the federal government, and are kind of this quasi-private public entity right now. Well, for several years now, there's been a push to make them private again, and basically for the government to completely be out of the mortgage business. There is some wisdom in that. I don't think that the government should inherently be in the mortgage business. However, there's a question of timing, right? Is this the right timing to do this? Because if it's not done right, it will cause mortgage rates to get higher, right? Whenever you take something that's functionally government subsidized and just privatize it overnight, that thing usually becomes more expensive, at least in theory, right? All of these things are in theory. Now, and of course, any of my libertarian-leaning friends, trust me, I know. There are a gazillion examples of that not happening. I understand. Please don't come at me in the mentions. However, come at me in the comments if you want. I do want that. But that is another factor. I'm hearing that we might have Fannie and Freddie open to the public to be privately traded as early as the fourth quarter of this year. And if that happens, that could have a negative effect on mortgage rates as well. So I don't know if the timing is right for this. If I were the president, I would probably wait. I'd probably hold off a little bit. But he seems like he feels like this is his time where he has the most political capital to make these sorts of big moves. And so he might feel like this is really the best time to do it. And quite frankly, he might be right from a political capital standpoint. So we have a ton of moving parts here. And I'm going to be with you guys every step of the way, telling you what's happening. But for right now, we got mortgage rates somewhere in the mid-6s, loosely speaking, depending on what your credit is, depending on what you can qualify for, etc., etc. They could go up, they could go down. Nobody knows. We got spreads. We've got privatization of Fannie and Freddie. We've got market volatility. We've got a whole bunch of fun stuff coming up for the remainder of this year. I'm going to keep you guys on track with it for the entire year. But that's it for today's episode. Hey, I winged it. Did I do pretty good? Let me know if I did pretty good. That was just all off the top of my head. I wasn't relying. I normally have like notes in front of me. I had no notes. I I completely did that entirely. I just ad-libbed it. So, is that the right word? I don't know. But let me know what you guys think. My contact info is in the show notes if you need to contact me for any of your local real estate needs. And please, if you enjoyed this content, please just subscribe so you don't miss future content. Like the episode. Listen, you're gonna hit the pause button. If you haven't already, hit the like button. And please, if you can leave a comment, if you can leave a review, all those things would be great. Appreciate you guys. We will talk again next time.